Hey you guys, welcome to another video of Trading the Process with me. On today's video, I'm just going to do a simple, pretty much just show you guys my framework on what I use weekly before entering the markets and before execution. So yeah, this is my weekly liquidity trading model. So, I'm doing it in a presentation view. So, yeah, without further ado, let's just dive right into it. So, a quick background on myself. My name is Aisha. I'm a trader in progress who refuses to rush the process. I didn't grow up with financial advantages. I was raised by a single mother and experienced real struggle, whereas, getting put out, seeing our stuff getting put out on the side of the road, having to move in with my mom's friend for a while until she was able to get back on her feet. And it doesn't end there. But yeah, those struggles taught me resilience early, and those experiences shaped my mindset and pushed me to build something different for my future. So through consistency, structure, and honest lessons, I'm growing daily while helping others navigate the early stages of trading with clarity and confidence. So what we'll be covering is a live trade breakdown, my gold trading framework, my weekly liquidity reaction model, the levels I watch, and my trading strategy. Okay, gold trade from last week. Before we get into the execution, I just want to take a quick look at the charts. All right, so you'll notice that I have some key levels marked out already, and they are, as you see, this is a key level, and two other key levels, as well as it's just the previous week highs and lows. And these levels I watch every week when I'm analyzing the market. And when price move into these areas, we often start to see reaction from the market. And you can see on the chart, just like I just showed you, my key levels. It came, you can see on the chart that price came into these levels and we had a reaction of each level once it hit. But the question is, why did that reaction turn into a trade opportunity? And that's what I'm going to break down next. So now to understand why that trade worked, you have to first understand the framework I use to trade gold. I call it my weekly liquidity reaction model. And the idea behind it is actually very simple. Each week there are a certain each week there are certain levels in the market where liquidity tends to build up. These are areas where a lot of traders have stop losses and orders sitting in the market. The main levels I focus on each week are the previous week high, my previous week low, Friday high, and Friday low. These levels matter because that's where a lot of money is sitting in the market. So naturally, price tends to be drawn towards these areas. And when price reaches those levels, we often see the market react. And that reaction is what I'm looking to trade. So now, once price reach one of those key liquidity levels, this is the process I'm looking for. First, price reached the level. As you see, I have the key levels marked out on here as well. Price reached the level. That's where liquidity is sitting in the market. Next, we look for the reaction to these key levels, right? So that reaction tells us the market is responding to that liquidity. After the reaction, price will usually pull back. As you see, it pulled back right here. So the sequence I'm following is very simple. You mark your levels, your key levels, wait for a reaction, a pullback, and then entry. Level, you wait for a reaction, it broke below, then it pulled back, and then we enter on a continuation. Right? So, and once I'm in the trade, my target is usually the next area of liquidity. So now that you understand the model, let's get back to the chart, and I'm going to show you guys on the chart as well. Sorry. Step one is my key levels. The previous week high, previous week low, Friday high, and Friday low, right? And from there, we identify, as you see here, I have this mark where it's showing this is a lower high that has been formed, right? So sellers are defending this area here. So as you see, it's being respected, and many traders are putting their stop losses above this, which would be like targeted for the next area of liquidity. But again, sellers are defending this area. So it was a reaction, as you see. It came below that resistance, and then it retested, pulled back, and then it continued down. And I could have, called the next liquidity area, which was Friday low, but I just caught not too far above Friday low. I meant Friday high, sorry. So yeah, so that is my exact step every time I approach the chart. Notice something, the trade didn't happen randomly. It followed the exact sequence we just talked about. So before the trading week begins, the first thing I do is mark my key levels on the chart, and I will show you guys how I mark my previous week highs, my previous week low, Friday high, and Friday low. These levels are important because they tend to hold a lot of liquidity in the market. That means a lot of stop losses and orders are usually sitting around these areas. So when price moves into one of these key levels, we often see the market react, and that reaction is what I'm watching for, right? So one thing I want to point out is that I'm not looking for trades everywhere on the chart. I'm mainly focusing on what happens when price reaches one of these key levels. And I'm gonna show you guys how I keep doing it. How I mark my key levels. So I'm gonna just go to a random chart. Let's just do BTC, right? Okay. So when I first approach the market, I mark on we could do it on the 4 hour, right? So when you first approach the charts, okay, the previous week high and low is according to the previous week, of course, from that Monday all the way up until that Friday, right, which is right here. So Monday started, let me widen this a little bit more. Okay, so this was the start of last Monday up into Friday. So the start of Monday. So the previous week low is the lowest candle during that trading week, and the previous week high will be the highest candle during that previous trading week, which is this, and it goes the highest week pretty much the highest week. The biggest candle with the longest wick is how you mark your previous week highs, previous week low, Friday high, and Friday low. So now let's mark the Friday high and Friday low. So we do that accordingly to last Friday, that whole day. So this is the start of last Friday, and Friday ends here. So from here, so the high is, it would be Friday. What did Friday end? Okay. Okay, so this would be previous Friday low. And this was the previous week high. Previous week low, Friday low. Now we have to do Friday high, and Friday high is set it. Hold on. Friday high. It's Friday low. Okay. And this is Friday high as well. So yeah, perfect. So now this is how I mark my key levels for the week. Previous week low, Friday low, previous week high, and Friday high. And you wait for reaction to these levels, right? All right. So I'm sorry. Oh, I went back. First, I mark, okay, as you just seen, I just showed you guys how I mark my key levels. So the first thing first, I mark my key levels. These are the key liquidity levels we talked about previously, the previous week highs and lows, and Friday's highs and lows. Next, I watch how price reacts when it reaches one of those levels. And when price get there, a few different things can happen. Price may sweep the level, meaning it briefly move past it to take liquidity. Price may respect the level and react from it, or price may break through the level completely. So I'm watching carefully to see how the market behaves at that area. After the reaction happens, I wait for the pullback. I'm not chasing the move. I wait. I want price to pull back first. And once that pullback forms, that's when I look to enter the trade. And from there, the target is usually the next area of liquidity. So now that you've seen the levels I watch and the strategy I follow, let's go back to the chart and walk through this process again and show you how it actually plays out. So let's go back to gold. All right. So what we just discussed, price, it was a reaction here. As you see, we had a reaction here, a reaction here to the previous week high. It broke below the previous week high. It came back, it pulled back, but here was like a lot of consolidation going on right up in here. So we wait. When we have consolidation is forming, we wait. So I'm trying to find another good area to show you. Okay, so let me go back down to the hour. Right, okay, so price, as you see, price reacted to this level where the sellers are sitting at in the market. Like I explained earlier, you have seller sit in the market. So a resistance has been formed. So this area is being respected. Okay, it was a reaction to this area, which pushed the market back down. The sellers pushed price back down, and it pulled back again to this area. So now we are bearish. So price reacted again to this area, and then this is where you can pretty much shoot for the continuation, right? So I really could have got in like here, and I could have targeted either the previous week high, the next liquidity area, which would have been a 1.5 ratio risk to reward, or I could have targeted the next area of liquidity, which is Friday's high, and that would have been almost a 3-to-1 ratio, a 2.72 to 1 ratio, right? So one thing I always want traders to understand is this: we don't predict the market, we wait for the market. I'm not trying to guess where price is going. I'm simply waiting for price to reach one of my key levels. Then I watch how the market reacts. And once that reaction happens, that's when I begin looking for the opportunity. So instead of chasing trades or trying to predict moves, I'm just waiting for the market to show me something first before doing anything. So yeah, let's hop back into the charts once again, just to show you guys, just repetition is the key to this game, right? You repeat the same process over and over again, and that's how you master that, and you get that confidence, that self-confidence, as in your strategy works, and every time you see that in the market, you don't hesitate to take the trade. So let's see if I can find another area that would have been a great trade. Where liquidity? Okay, like right here, price, it was a reaction. Here we had a reaction to the previous week low. Price broke above the previous week low. Pretty much just grabbing liquidity. As you can see, it stayed above a little bit, but not much, and it came back below the previous week low. So this here is considered a liquidity grab. This here is considered a area of liquidity, a liquidity pool right here. So price came back down, sellers pushed price back down, and we still do not enter. We wait. As you see, it pulled back, and this is what we wait for. We wait for the pullback, and after the pullback, we enter on the continuation, right? We enter on a continuation. And we target, and we will place our stop. And we can place our stop right where the sellers are sitting at in the market, or we can target the last low or high, or just right above. But yeah, so we would target the previous low or high, and then I always maybe like a 1.7, 1.5 ratio to up to 2, maybe 3, depends. So, but here, yeah, we would have got a good 1.36 ratio, risk to reward. So, yeah, and that's simple. And that's my simple strategy I use every week before I enter the market. And yes, this is the simple sequence I follow when a setup forms: level, reaction, pullback, entry. That's the process. And once I'm in the trade, the target is usually the next area of liquidity. So the ideal itself is actually very simple, but the real challenge in trading isn't the strategy. It's having the patience and discipline to wait for the setup instead of forcing trades. And that's really the main takeaway from today's session. Trading doesn't have to be overly complicated as people portray it to be and try to put it as, but a lot of time it's about having a clear process, staying patient, and executing consistently. And yeah, and if this video helped any one of you all tonight, thank you for watching. Like, comment, and subscribe. But until the next video, bye you guys.